Dear risen investment gurus, we're so proud of you. You've gone through worksheets 1 and 2, maybe multiple times, hopefully multiple times before you then tackle the assignment. I certainly hope so. Because now we're going to show you the most respected and trusted sources of data analysis for stocks, and that is the value line. And we're going to show you how you can use that data, just a tiny little piece of the data they offer, to populate a spreadsheet that does all the work that we discussed for you. So we want you to learn how to do it manually, but then obviously that's why they have computers, right? That's why they have tractors, so we don't hoe the land by hand, we don't plow the land by hand, and we don't do all these calculations by hand once we've learned what we're doing. So let's get started on slide 37. The value line, still one of the most respected and trusted sources of data and analysis. Now, there are other companies nipping at their toes. These guys have been around for over 90 years. For many years, S&P had a competing service, which I didn't think was very good. I haven't seen it in a long time. It's now called CFRA or CRFA or something like that. And then Morningstar, who are very aggressive, who ate Lipper's lunch in the 1990s and 2000s, and now they're trying to eat Value Line's lunch. And some people tell me they really like it. I thought it was okay, but I still like the Value Line. It was traditionally often the only source that many investors used for data and analysis, along with the company's materials, of course. It's not cheap, folks. If you want an individual subscription, $50 a month, right? I think they maybe give you discounts now because it's all online. They used to have to send you all these paperwork. That's not cheap, but now it's all online. But I still love the papers. But you know what? It's all available at the library. I know. Those librarians are scary, but they're really pretty powerful folks, believe me. And so you can always go to the library and see the value line. But now more and more people are using it online. I am a big fan of the value line, especially their timeliness and safety indicators and the 3 to 5 year price appreciation prediction. Oh boy, I love that. One study, which ignored transaction costs and tax consequences, only used their timeliness indicator. It showed how you would have beaten the market handsomely over a 20-year period by simply buying and selling stocks as they received and then lost their number one timeliness designation. Now, the timeliness is more for, 18 months, they'll tell you, 6 to 18 months. I want to know how well they're going to do over the next 3 to 5 years, and we're going to see why and how. So here is the slide that says, can you find the following? The value line indicators, the future price projections, the historical data, the cash assets, the receivables, inventory, other assets, the description and analysis of the business, the historical annual rates and predictions for those annual rates going forward, the insider and institutional buying and selling, the amount of debt, the number of shares outstanding, the financial strength of the company, the stability, the price growth, earnings predictability. Oh my goodness, it is a sip from the financial fire hose. And we're going to use Johnson & Johnson. Why? For many reasons. This company's been around for over 100 some odd years. But it's fairly predictable company. Yeah, exactly. It's not real high tech or anything. Of course, some of the things they do are very high tech with the drugs and the medical devices. So here is on slide 39, the top page. When you go online, you will see that this is available to you. You can download the PDF, and I still use that, but more and more, especially to younger folks, like the online materials. It's actually more than what's on the PDF file, the print. I'm old, folks. What can I say? This was my idea of a great time. My wife loves historical novels, and I love the value line and investing. So we would go to the Point Loma Library, which is very close to where we live, and they had the value line. The OB one doesn't. And this would be, Saturday afternoon, Sunday afternoon. She would comb through historical novels and wind up with about 5 or 6 to take home. and I would sit with the value line and pull out the sheets. Cool thing about it is if you go to the library and use the sheets, they put the competitors right next to one another. So if you look for Coca-Cola, right next to that will be Monster and Pepsi-Cola, right? And so once you find the one, you need the index to find the one, and then the rest are very close. So here is all the information that the value line is going to give you. Now, notice we've highlighted in red the stuff that we're interested for our models. There's a whole lot more out there. Here is the price as of what was this? This was at the end of December, right? They come out every company's comes out every 4 times a year, every quarter. But if you go online, of course, it'll give you the updated price because it's changed so far. PE ratio, dividend yield, and notice this little gray area. That's the last recession. So you can see how well they handle recessions. Very cool. But this is my baby right here. Look, remember we said, well, what is the price in 3 to 5 years? How am I supposed to know? Well, what the value line is going to do is they're going to give you a range. And they'll tell you in here it is. The numbers are 190 to 230 because you can see them right here. So they believe that, 3, 4, 5 years from now, we're going to see a price of between 190 and 230. Now, are they guaranteeing this? No. They're just saying, this is what we think. And then notice the timeliness is 3. They're not too excited about the next 16 months, 18 months or so, 6 to 18 months. That's their timeliness indicator. Notice their safety indicator. Hey, yeah, Johnson & Johnson. They ain't going anywhere. They have their roots deep in the economy. And this technical, we'll discuss technical analysis later on. They don't tell you how they do that. They just say, hey, technicals too, whatever that means. Technical analysis, I think, is a little bit better than voodoo, but not much. Now, here, sales per share through the years, cash flow per share, earnings per share. Why is cash flow and earnings different? We'll talk about that next chapter. And here, dividends declared per share. So this is going back several years. We're only going to go back 7 years, including 2025. And so this is what they're going to pay this year. And notice, they think in, 27, 28, 29, the dividends are going to be $6. Right, so they're not, of course, this is not guaranteed. And then look at all these things. Sales, operating margin, depreciation, net profit. What are these? We'll discuss these later on in chapter 5. The capital structure. Oh my goodness. And now here is the second page. So remember, we're going to use this data here, the 3 to 5 year price prediction, and the dividends going backwards. And we're also going to take a look at the bottom sheet. And here are the annual rates for sales, cash flow, earnings, dividends. We don't care too much about book value. Some people do, but this is what the past 10 years, past 5 years, and now what they estimate the next 3, 4, 5 years. And this is required reading, folks. You must read what their analysis is. And for me, the money pitch is the last paragraph here. Because this is where they basically say, yeah, we think it's a great idea. Or, nah, we don't think it's a great idea. Or, maybe. In this case, they're saying the high-quality stocks' long-term total return potential is below the value line median. Which is basically saying, yeah, we don't think it's really worth what its price is right now. But that doesn't mean it's not a good choice. If you read through, you'll see that, hey, this thing's been around for, I don't know how many years, and it's going to be around for many more years, and it's, paying decent dividends, but we're just not too excited about the prospects for the next few years. So more momentum-oriented, aggressive investors might say, yeah, but some of us, people who just love dividends and love the fact that they're increasing their dividends might say, okay, it's not bad. Maybe I can wait for a price to fall, or maybe not. Maybe I'll buy some and see what happens. But now we're going to use all this data, especially the data that the data that we showed you in red, to create a spreadsheet, to populate a spreadsheet that's already been created and do all the calculations, the Gordon growth model, discounted cash flow model, and the internal rate of return that we've discussed so far. So, slide 41. A sip from the financial fire hose. Remember when you were a kid and you drank from the fire hose? Maybe you still do. But this is I'm not the fire hose, the garden hose. But this is a fire hose. Interspersed among the mountain of data, did you notice the highlighted historical dividends, the future stock price predictions, the predicted growth rate of the dividends? There are other models that use the sales, earnings, cash flow, profit margins that are in here. Did you read the company analysis? Well, I read some of it for you. Personally, your humble instructor does not make any decisions about individual stocks without first consulting the value line. So now let's take a look at the spreadsheet that uses data from the value line to quickly calculate the Gordon growth model and the discounted cash flow model's predicted values. So here we go. Here it is right here, the value line. Make sure you do worksheet number 1. There's the commentary, the answer key. Folks, you got to do them over and over and over again, please. Because once you've done it enough times, the calculations are super simple. The words are weird. Talk to yourself about what you're doing. But here's the spreadsheet, and there's a presentation on how to use the spreadsheet. So I'm going to click on this little bad boy here. And oh my goodness, look how small it is. Oh, I know why that is. Let's make it bigger. Boom, boom, boom. I do that because of the way we, it's a long story. Anyway, so you can't see the years. You don't see the years there. You put in the year, because let me make it a little bit bigger. Make it now you're starting to see the year. Now you're starting to see the years, because it has to do with the way this program, Camtasia, records the spreadsheet, the presentation. But anyway, we put in the dividends for the last 7 years, including 2025. And remember that was highlighted. And we also put in the current price, the predicted price, and then the predicted dividend growth rate from the value line. So what we see is that we used Google Finance on February 5th to grab the price. And of course you could put in the new price today. There's actually a way to make a formula that'll grab the price off the internet. It's a little tricky, but it's not that hard. But I wanted the price to stay the same because everybody's going to look at the same spreadsheet then. Now, the predicted price is the midpoint of 190 and 230. Do you remember? Value line was saying we think 3, 4, 5 years from now, Johnson & Johnson is going to be between 190 and 230. So what I did very simply is take 190 and 230 and divide it by 2. That's the average, right? Now, what I often do will pick a lower point. I would pick 195, maybe 200, because I'm more conservative when it comes to my investments. That makes sense. I'm a lot older than some of you. I'm not older than all of you, probably. So, but you, as a younger person, if you're younger, might say, no, I want to be more aggressive. I want to see what happens if it goes up to 230, or maybe I think it's going to go more. This is where judgment comes in and risk tolerance comes in. There's no right or wrong answer, folks. You might not agree with the value line. You might say, I think it's only going to be $170 or $150, whatever. But this is why we do these. I know it sounds a little squishy, but we do these in conjunction with our own risk tolerance and judgment. Now, what happens? Put all that data in, and the spreadsheet does the rest. What it does is it computes the average dividend growth rate over the last, 6.5 years, I guess, 7 years, 2025 is just getting started. Whereas the value line is, so we're saying, we think it's going to continue at 5.6%. Yeah, because that's what it's been the last 6 years or so, 7 years. Where the value line is saying, we think it's going to be 5%. Now, those numbers are very close, and we're going to find that our results are very close because of that. So you got it. You put in, go to the value line, get the dividends for the current year and the last 6 years, And of course, if you want to, you can tweak this spreadsheet once you know what you're doing and make it 3 years or 7 or 10 or whatever. And then put in the predicted price that you've gleaned from the value line, whether you pick a higher, lower, or in this case, we're just picking the midpoint. Put in what value line thinks the next 5 years are going to be for dividend growth rate. And then the spreadsheet does the rest. It calculates the average growth rate. And then here's the Gordon growth model, using both the average growth rate that we computed and the predicted growth rate that value line thinks. And notice that the Gordon growth model is very, very sensitive. So notice that at 12%, doesn't look too good. At 10%, still doesn't look that great. But at 8%, the Gordon growth model is saying, you know what? If you're happy with 8%, Johnson & Johnson looks like a pretty darn good deal. And I agree. Can we reasonably expect 12% from a Johnson & Johnson? You know, maybe, but I don't think so. They're so big to begin with. It's not like they're growing that fast, but they're still growing. So don't get me wrong. And they're also into drugs, into drug development. My apologies. In fact, you might have gotten their COVID vaccine. And that, you never know. That's the weird thing about the pharmaceutical world. You never know when they come up with a new blockbuster that just sends profits through the roof. So that's the dividend. There's the Gordon growth model. Very simple. And notice how the different average growth rate versus the predicted growth rate changes the predictions. Yeah, it's very sensitive. Now, it then does the discounted cash flow model for both I'll move over and I'll show you. See, this is our average dividend growth rate that we calculated, 5.6%. And then it does it for the value lines, 5%. And you'll notice that since those two numbers are so close to one another, 5 and 5.6%, that the results are, within pennies. They're very, very similar to one another because the dividend growth rates are very close to one another. Cool. You don't have to use the present value tables. You don't have to use the exponential formulas. The spreadsheet does it all for you. Now, we put a lot more stuff than we really need to. We put the present value multipliers. And I did that from a teaching standpoint because we wanted you to see it looks just like the presentation that we did. And that's how we do the worksheets if you look at the answer keys. But we don't have to show all this material, all this transactions. Calculations. But I think it's a good idea just so you can check your work. And then lastly, there's the internal rate of return. The internal rate of return takes the current price, and then because that's a cash outflow for both our 5.6% predicted growth rate and value lines predicted growth rate, and then calculates into the future what they think the dividends are going to be using our predicted future stock price of what did we do? 210, right? 210, 190 and 230. So that was 210. And it says if you do receive those future cash flows and the stock price is 210 in 2028, you're going to get a little over 11%, which is, again, I think it's a little too much to expect from a Johnson & Johnson. I might lower my prediction for the stock price. As I said, I probably would. I'd probably use 195 or something like that. And that's what's so cool about this. All we have to do is go in here. Now I'm working with the original, so I really shouldn't do this. But all we have to do is go back and change it to 195 and then see what the internal rate of return is. And the internal rate of return says 9.44%. So, and then the present value at 8% discounted cash flow says, yeah, it's not a bad price, not a bad deal. At 10%, well, that makes sense because the internal rate of return is 9.5%. So it would make sense that the present value at 10% would not be up to snuff at the current market price of $154. But at 8%, sure. So what do you think? Is this cool or is this? You aren't, folks, I am so proud of you. Why? Because I got to go put this back. How do I put it back? There we go. Okay. You are now investment gurus. You now understand the value of money that is coming through the door, not today, but a year from now, 2 years from now, 3 years from now. And you now have the tools to compute those present values. And you now have just one, although I think it's still the best, my humble opinion, but that's why there's chocolate, vanilla, and some people like strawberry. You now have seen a securities research report. That's the fancy term for the value lines research. And realizing that they're not the only ones. And you also, I hope, have an appreciation of why we dare not go out more than 3 to 4 or 5 years. It's just ridiculous to even think we could. I mean, even 3 years is pretty darn hard. Next year is difficult. But as we said before, we do these to point ourselves in the direction of high quality companies, roots deep in the economy, prudent, long-term, successful investments that aren't going to make us wealthy overnight. We're not going to hit the big time overnight, but also won't bankrupt. Won't make us very sad. Okay, so now we took a look at that. Now what we're going to do is in the next slides we're going to and see what happens when I make it. I'm going to make it small again so that thing disappears. I've been trying to get rid of that, but I don't think you can. Okay, so here is in the slides are what we just went through. You put in the dividends per share for the last 7 years, predicted price from the value line in 3, 4, 5 years using your judgment, whether you want to go low end, which is what I do, or the higher end, which is maybe what you want to do. The spreadsheet calculates the 5.6%. We put in the 5% from the predicted dividend growth rate, and it does the Gordon growth models. And remember, the Gordon growth model is very sensitive to our required rate of return. Notice between $85 or so, that's would be 86 almost, to 228. And then the next one shows the discounted cash flow model. Here we calculated the predictions from the discounted cash flow model using both our computed average dividend growth rate of 5.6% over the past years and the value line's predicted dividend growth rate of 5% for the next 5 years. And we saw that because 5% and 5.6% are fairly close to one another, growing the dividends forward, the predictions are very close to one another for at 10% and at 8%. And notice that even at 10%, at $154, the model is saying that, we think it's a pretty good deal. But if we drop that predicted price, as I did, to $195, then no longer at 10%, but still at 8%. Are you getting the idea that this is not an exact science, folks? I hope so. It takes a lot of judgment. It takes years. And you're not always going to be right. You know you're not going to be right. But that's okay. I mean, think about it. If you're in the major leagues of baseball, if you get a hit 3 times out of 10, you're doing okay. In fact, you're going to make millions of dollars. Now, I believe you're going to do better than that if you follow the techniques. And I certainly believe that. If you follow these techniques, and every once in a while you buy a hot stock like the Jeans R Us that may do really, really well, but probably won't. But you buy a bunch of Johnson & Johnsons and Pretzels Unlimited and Exxon Mobil's and who else? I mean, Home Depots and Walmart's. And yeah, you're not going to get rich quickly, but you're also not going to get poor quickly. All right, and then lastly, the internal rate of return calculation using both our average dividend growth rate and the value line's predicted growth rate. And we see that, hey, if indeed we do get that 210 price, which I'm thinking maybe a little bit too optimistic personally, that's my judgment, you decide, you're going to get over 11%, which from a company like Johnson & Johnson is pretty darn good, folks. Would you consider owning Johnson & Johnson? As I said, you may have gotten their COVID-19 vaccine. Actually, it wasn't too popular in the United States. It was used throughout the world. Here in the United States was the Moderna and the Pfizer. Those were the two big ones. And so, oh, isn't it great not to have a global pandemic? Don't worry, another one will come along. We think we're in charge. No, the virus has been around for over 2 billion years. Slide 45. Ay, payano, do we really have to use the spreadsheet? It's so confusing. Well, we promised that you could perform all the calculations in this course with a 99-cent calculator, and we've kept that promise. You don't need the spreadsheet. You don't need exponentiation. You can do all these calculations manually, but wouldn't you rather bang away at the spreadsheet? It's given to you until you figure out how to use it. It ain't that hard. Spreadsheets, again, they're kind of like big bingo calculators. B3 plus I2 plus N5 plus G4 plus O1 bingo, The real prize here is that all we need to do is consult the value line or Morningstar or CRFA or CFRA or whatever it's called, or whomever, for the data to use in our spreadsheets or our manual calculations. Are you excited? Yeah, I hope so. I certainly am. Of course, I'm not biased. I just teach this stuff. But stock's been very, very good to me over 30 years. Actually, a little longer, but I use 30. Slide 46. Are you excited? Because now it's your turn. Go online or find a library near you that has the value line. Think of the few companies that you would like to research, maybe downloading their annual reports from their websites beforehand. Ask the reference librarian for the value line packages. It's this huge. This is just one of them, and this is the one that we're interested in. The big companies, I think there's 1,700. They also have 3,000 smaller companies, and then they have some other things that they have. I'm not sure exactly what, but you want the regular one, the one that's been around for 90 years. It's huge. Sometimes they have it in this huge 3-ring binder, but usually they've broken it up into little binders. You have to find the index, and that's usually the first package. Then you look in the index for the company, and then it tells you which package to grab, which it's a number between 0001 and like 9,000 or something like that. Then you go run to that package, and as we said, they group the competitors close to one another so you can easily look at the competition. And I've said this before, we want you to get lost. In a nice way, of course. Have fun. Because if you enjoy this, this is a great sign that you could be your own financial advisor and choose stocks, monitor them. You just can't buy a stock and forget about it, folks. You got to be watching the company because things change. The story changes, as Peter Lynch says. But if you enjoy it, it's a very good sign that you're going to be successful. And there's a future for you in the industry. And if you absolutely hate this and you're cursing me now because you don't want to do this, or, well, at least try it a few times, right? Because maybe you'll come around. Then that's why there's mutual funds. Yeah. And I'll also hear people who will trash the value line. But I get a kick when some speculators, traders, short-term investors, that's an oxymoron, not short-term speculators, trash the value line. Look, they make mistakes too, just like everybody else. They'll be the first people to tell you these are just our beliefs. We don't guarantee them. But I would sure love to see how those traders' long-term results stack up against the long-term results of the value line. Who do you think would have the better results? Because, folks, when you're a trader, when you're a speculator, you can lose big time, quickly. And then it takes a while to get back. I'll never forget one of my students a few years back was always asking me about this one gentleman who's very famous as a technical analyst, and I was looking it up and I was thinking, I don't know. But he asked at the very end of the semester, we have the face-to-face class, we have this thing called Baffle the Broker, and he asked, do you really believe that you cannot accurately predict using technical analysis? And I said, I haven't seen anybody who has done it. That doesn't mean there aren't. I know I can't do it. I can't figure out what it means. And I just said, you got to be ready to lose a lot of money. And he goes, well, I've lost everything 4 times. I've gone to zero 4 times. And the whole class turned around and looked at him. I thought, Oh boy, I mean, you really do have a high tolerance for risk. Can you imagine me? You'd be coming to my funeral. I went up to my wife and said, "Dear, do you remember that retirement portfolio that we used to have?" Yes. Why? Wait, we used to have? What are you talking? Yeah, that's why there's people who are very, very high risk, and there are people like me. But that doesn't mean we shouldn't invest in stocks. We should, because we saw from chapters 1, 2, 3, and 4, the news is good. Unless the world ends, and then it doesn't matter where your money is. Slide 47. What's the bottom line? Read this carefully. I certainly hope you've gone through this to at least read this slide, because once we have finished all of our valuation calculations, what should we do? Should we really place much value on our predictions? The answer is no, 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 no. Rather, we should hurl them into the vast ocean along with the ashes of our dead pets and relatives, or shred them into millions of little pieces of confetti and use them as confetti at our next party. Or, my favorite, burn them in a huge bonfire as we dance naked under the full moon. Or all three. Look, folks, we do these calculations to simply tilt the odds in our favor. Instead of placing any significance on our predictions, after we have finished, we should ignore them. Ask ourselves some very simple questions. Do I want to own this company? Do I want to be a partner with this company? Do I believe this business will succeed? Their products, their services. Warren Buffett said, don't buy a stock, buy a business. Peter Lynch, and you're going to read One Up on Wall Street and maybe Beat the Street, which is his second book, but One Up on Wall Street's the best. He would, and this is before the internet, folks, this is 1977 to 1990, he would, for every company, have a 3-ring binder, and he'd put all the articles that he found and all his calculations in the 3-ring binder. And then before he would make a decision, he would hold it up in his hand and give himself the 30-second, 90-second, 60-second story. This is Nike. I want to own Nike because it is the premier shoe, whatever, apparel, whatever they are called, tennis shoe company in the world. Their stock price is down because of this, this, and this, and this, but I believe it's going to come back because of this, 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 and this. And then after he gave himself that talk, he knew whether he was going to buy it, hold it, or sell it. And he would do that, regularly. Every company had to keep going back and giving himself the story. And I really like that idea of the story, because every company there's a story for every company. Huh? What do you think? I think so. And of course, we've done all our research, right? This is just the beginning. The stuff that we're doing here is just the beginning. We got to go read the annual reports. We're going to learn how to do the financial statements. We have to read all the articles we can. We have to look at their competitors. Right. and their customers and their suppliers and the marketplace they're in and whether they're global and all that other stuff. Yeah, it's a lot of stuff. And then we have to decide, make a decision. The final word on valuation we leave to Mr. Seth Klarman, who wrote a phenomenal book back about over 30 years ago that's out of print, and people keep asking him or the publisher to bring it back, and they don't want to do it. But when somebody publishes it online for free because you can't buy it anymore, they attack them for copyright violations. That's kind of sad. But I had a chance to read it. It's a very good book. It's not mine. My friend of mine lent it to me. Because now they're going, copies are going for hundreds of dollars online. The problem, as Mr. Seth Klarman says, the problem is that it is easy to confuse the capability to make precise forecasts with the ability to make accurate ones. Any attempt to value businesses with precision will yield values that are precisely inaccurate. We know beforehand that when we make these calculations, there is a 99.99% chance that they will be inaccurate. Well, so why do we perform them? These calculations help us identify companies that are prudent, long-term oriented investments. They won't make us wealthy quickly, but they should make us wealthy unless the world ends. To quote a very wise client of mine, I don't have to win big. I just have to win. Because I had done my spiel where I said, this is the kind of investments I like. I like, prudent, long-term oriented, boring companies that have their roots deep in the economy. And he kind of had this grin on his face. Very smart man. And he said, I like that. I don't have to win big. I just have to win. And that's the way I feel. I don't have to win big. I just have to win. And these kind of companies will help you do that. Whereas the very speculative issues that we'll see some examples, I like the phrase speculative issue is what Value Line calls them. They could make us wealthy overnight, folks, but they usually make us very sad. What do you think? Slide 49. That's our fundamental analysis valuation models. Now, do those worksheets over and over and over again, then play with the spreadsheets, do the assignments, and you are now official investment gurus. You will never look at an investment again, potential investment again, with just, I don't know, what do you think? Oh, I don't know. You'll say, what are the potential future values, future cash flows, and how do we bring them back to the present to give us an approximate valuation, realizing that we're just sticking our finger up in the air, seeing which way the wind blows. Thank you for being in our class. And now in our next chapter, we're going to take a look at the financial statements and do some ratio analysis. Nowhere near as exciting as chapter 4, in my humble opinion, but very important. Go get 'em, Tigers. We're so proud of you. You are now the official investment gurus for your friends and family and colleagues. It is a very weighty responsibility.